We're starting to see layoffs mount, and that could be really scary and an early indicator that we're heading into a consumer slowdown and a potential recession. So should you be afraid? That's what we're going to cover in this video. So smash that like button, and if you're new, please consider hitting that subscribe button. You're watching More Money, let's get it. What's up, guys, and welcome back to the channel, where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into this, because this is pretty scary information. So you can see here that Elon Musk just made news by saying that Tesla plans to cut 10% of their salaried staff because he's afraid of what's coming in the market. And that's on the heels of Jamie Dimon saying that we need to brace ourselves for an economic hurricane caused by the Fed and the Ukraine war. So effectively what he's saying is that there's two main factors that he's worried about. The first one is quantitative tightening. And so effectively what that is the Federal Reserve is going to take $95 billion of liquidity out of the market every month. And so that's going to just make money tighter and more expensive. The other factor that he's worried about is the impact on commodities from inflation, wars, and how that impacts the prices of food and fuel. He believes that oil could hit $150 to $175 a barrel. So you guys can understand why investors like Warren Buffett have been scooping up oil names in this environment. And so because of those two risks, which we've been highlighting on this channel for a long time, Jamie Dimon did tell investors, brace yourself, and that they're going to try and shore up their balance sheet to address any potential risks that could come down the pipe. Now, moving on, one of the areas that got hit the most recently year to date is the technology companies. You can see that so far in June, they've actually had a bit of a rebound, but overall, they're still down 22%. But the reason why I bring this up is you can see here that there's been notable tech layoffs. So Getter is laying off 4,400 people. Carvana is laying off 2,500 people. Klarna is laying off 700 people. Now, that chart by itself is not really that concerning. However, it's the number of names and quality of companies that have decided to freeze hiring, which is acting almost like a bellwether into sort of like an indication that we're heading into a recession. So you can see here that Microsoft has decided that they're going to slow hiring for its Windows, Office, and Teams software groups. NVIDIA, big name in the chip space, is expecting to slow down later this year. They're going to focus their budget on taking care of existing employees as inflation persists. Lyft, and you'll see Uber next, where Lyft is slowing down hiring and focusing on their critical open roles. So effectively, they're going to try and manage their budget by reducing hiring for the remainder of the year. Snap, they just didn't hit analyst expectations, and they're hitting the brakes on hiring throughout the year. And the company pointed to a few reasons why they're seeing a slowdown. Part of it is rising inflation, part of it is rising interest rates, part of it is the supply chain, the war in Ukraine, and Apple's new ad tracking policies. You can see that Uber is cutting back on hiring and other costs to address what they determine to be a seismic shift in the market. Now, you guys might remember, I actually did a 4-part series on doing Uber Eats as a gig. I ended up buying a pizza bag and just a general bag and did 250 deliveries. Now, interesting thing is I haven't done Uber since the release of those videos where I did those 250 deliveries. But recently, it looks like Uber's getting a little bit desperate for drivers to come back into the market. They just sent me a text message, an individualized text message from a real person saying, hey, what do we got to do to get you back on the road? And one of the concerns that came into my head is I wonder how much of a bite these Uber drivers are taking from these higher gas prices. Now, I understand that Uber did announce a fuel surcharge, but I don't know how much that fuel surcharge actually goes to cover the additional fuel cost that these Uber drivers have to pay for. So I really see a situation where more and more Uber drivers have come off the road. Now, I haven't confirmed that, but it almost makes sense to me that these guys, they weren't making a lot of money to begin with, so you can only imagine that now is probably just not worth it overall. Salesforce is slowing hiring to cut back on other expenses, including corporate, travel, and upcoming off-site. So we're back to the no traveling, which we saw during the pandemic. And then, of course, Meta is probably the biggest company, I would say, to have announced a hiring freeze. I would say Microsoft is probably the biggest. I don't know who's bigger, Microsoft or Meta, but, you know, they're both kind of, to me, in the same ballpark of, like, size of companies. And what's interesting about the cutbacks in Meta is that they're even cutting back on people that are working on the metaverse. So the hiring cutbacks will hit almost every team across the company and will last for the rest of the year. So that's kind of interesting that even Meta, who's cash flow positive in this environment, is probably seeing an advertising slowdown, and so they're cutting back. But that's just technology, and technology is the space that I'm least worried about. I don't think technology is the bellwether to predicting a recession. The industry that I do believe is the bellwether to predicting the recession is retail. And if you guys remember, retailers actually cut jobs in May while the overall payrolls grew by 390,000 jobs. So you can see here on this next slide that you can see that leisure and hospitality has been growing, although the curve has been slowing a bit. But notice at the bottom here where I've highlighted that retail trade, the retail sector actually shed 61,000 jobs in May, which is an outlier in the labor market that added 390,000 workers to payrolls in May. So without retail shedding so many jobs, we would have actually been up 45,000 jobs as opposed to 390,000 jobs. So retail is really telling a story, and that is that they're looking to cut back on staff because they're looking to cut back on costs. And like I always say, I do believe that retail is the leading indicator to suggest that we might be entering a recessionary environment, or at least a contractionary environment. And so how do you sort of operate in this environment? Well, there's companies that I do believe that have been oversold in this environment. I'll give one to you. So for example, you can see here that the one that's not blocked out here in our tracker that the Patreons get access to at the lowest level, you can see that Zillow is actually trading under 59% of its intrinsic value, or at least what I believe to be its intrinsic value. And Zillow is one of 7 names in the tracker that are trading under 50% of its intrinsic value. And you can see there's another 20 names that are approaching that 50% of their intrinsic value. Let's dive deeper into Zillow. So you can see the ticker for Zillow. It's actually highlighted in blue, and that means that you can actually click into it, and you can click into every one of the tickers on this tracker here. So let's click into Zillow to get to that model. So you can see here that once we click into it, you can see that Zillow actually ran into some challenges where they actually took losses in their home segment. And so I have it highlighted here on the box to the left here. They eliminated this home segment business, and losses are actually expected to be lower than originally forecasted due to the strong home pricing market. Effectively, they've taken on an inventory of homes, but this home market that has an unusually low amount of inventory has pushed up prices, and which has allowed Zillow to offload these homes and not take huge losses. And that was the fear earlier, because this algorithmic home trading business did present quite a bit of risks, and Zillow previously took huge losses on this. So it's nice to see that as they shut this business down, they're likely not going to take huge losses on it. And in fact, they might generate income on this that's not being forecasted. And the other point that I want to point out is notice how I have the revenue for 2025 highlighted. Management has guided to $5 billion in revenue by 2025. And the reason why they're getting there is because they are still continuing to grow out their IMT segment, which is their internet media and technology segment, and they're still growing out their mortgages segment. Now, I'm saying that by 2025, they don't actually hit $5 billion in revenue. I think they hit around 4.5, but even that might be a little optimistic. So we'll see how they get there. And so the reason why I'm looking for such a margin of safety on the valuation of this company is because there is a potential that they don't hit this guidance. And that's not a big deal at the end of the day, because Zillow is still the market leader in home search, and 10, 15 years from now, they're going to do just fine. So it's really an investment that I'm completely comfortable holding. But I wanted to dive a little bit deeper into this for you. So you can see here that in my EPS valuation, I'm actually valuing the business at $71.50 a share with just using a 20 times multiple and a terminal discount rate, which is really high, of 11.5%. But notice that I actually do believe that they have around $9 of excess capital. And the way that I got to that is I said that net of their convertible debts and home segment wind down, they have around $2 billion of excess capital. Management is guiding that they have about $1.7 billion of excess capital, but I think they're being very conservative on that because they don't know how much of a loss they're going to take on the sale of homes. And I'm predicting that they don't take a loss at all in selling those homes. In fact, I actually think that they make a bit of a profit, but I don't actually forecast out that profit. I'm just saying that they're going to sell their home inventory at the book value. And so just by doing that, we're getting to around $2.2 billion of excess capital, which of course goes into that valuation of approximately $80 a share. And so if they're trading at under $40 per share, you can see that it's a very compelling valuation. And so how do you get access to that model and all of that granular information, including just the tracker overall, to see what companies are trading under 50% of their intrinsic value? Well, you can get access to that with the Patreon at the lower tier. And like I always say for everyone, there's no risk to you, because if you decide after the first month that this is not for you, no problem. Message me in the Patreon app and let me know that it's not for you, and I'll completely refund your first month. So there's no risk to you. Now, the other thing that I want you guys to be aware of is in the next video, I'm going to talk about how certain CFOs are discussing their potential strategies in bracing for a recession. Some of them are suggesting that their business models are going to be safe from a recession, and others are looking at current indicators and giving their analysis on what they think the market's looking like. So in order to not miss out on the video, take a second right now and hit that red subscribe button and ring that notification bell to be notified when that video becomes available. And previously I put out a video where I showed some early indications that a recession is on the horizon. If you missed that video, no problem. You can get to it right here.